Welcome to the Case Study Learning Series in International Business by SkilledMBA. Today, we dive into the global expansion journey of CZM Foundation Equipment, a Brazilian drilling rig manufacturer navigating strategic decisions to enter the European market. This case explores real-world business considerations around international growth, including entry strategy, competition, and operational alignment. CZM was founded in 1976 in Brazil, focusing on foundation drilling rigs. By 2012, it had expanded into the United States, where operations thrived so significantly that the US became the company's global headquarters. Now, CZM looks toward Europe, aiming to leverage its growth momentum and global presence. CZM operates manufacturing in Brazil and maintains a strong market presence across South America. The US now serves as the global HQ and primary operations hub. In Europe, the company has supplier relationships in Italy, France, and Germany, and an engineering department in Italy, but no formal subsidiary yet. Several drivers support CZM's European ambitions: enhanced design capabilities through access to top engineering talent, supply chain optimization with stronger logistics across continents, new market access to Europe's expansive construction sector, and the potential to build on existing supplier relationships. However, CZM faces serious hurdles: intense competition from well-established European drilling equipment brands, regulatory complexity due to different standards and EU compliance, and market uncertainty driven by the cyclical nature of construction and economic fluctuations. The strategic decision requires multiple layers of evaluation. Should CZM enter the European market now? Which country offers the best fit? Should they enter via a wholly owned subsidiary or equity alliance? And what is the right timeline? Short-term or long-term? Italy is already home to CZM's engineering department. It has strong manufacturing expertise, but suffers from economic volatility. While existing presence lowers barriers, instability adds risk to a long-term investment. Germany boasts unmatched engineering excellence and a large, stable economy. However, competition is intense. Entering Germany means going head-to-head with the world's top equipment manufacturers. France offers strong supplier ties and an active construction sector, but its complex labour laws pose operational challenges. While attractive, navigating employment regulations will require careful planning. This mode offers complete control, giving the company full strategic and operational autonomy over its overseas operations. Another benefit is profit retention. Since the company fully owns the subsidiary, it does not have to share financial returns with local partners. However, this approach also comes with higher risk exposure. The parent company assumes full financial commitment and liability, making it a high-stakes strategy for international expansion. Companies pursuing this mode must be confident in their financial strength and operational expertise. The first major advantage is faster market entry. By leveraging a partner's existing infrastructure, the company can enter a new market more rapidly. Secondly, this mode offers local knowledge access. The company benefits from the partner's understanding of local regulations, customer preferences, and market dynamics. Finally, an equity alliance provides shared risk. Since both parties invest, the financial exposure is reduced for the foreign firm. This approach is especially useful when entering complex or unfamiliar markets, where shared expertise and resources increase the likelihood of success. Wholly owned subsidiary, 15 million with 3 to 5 years to break even. Equity alliance, 8 million with shared resources and faster integration. CZM must weigh control and risk against capital availability and strategic goals. The US will continue as the strategic hub, Brazil as the manufacturing base, and Europe as a potential engineering and market access point. The decision must align with global integration and enhance supply chain performance. Key decision factors include market opportunity in Europe's construction sector, how CZM can differentiate from competitors, financial risk tolerance based on capital, strategic alignment with the company's global vision. CZM's case offers a real-world lens into complex international expansion decisions. It highlights the delicate balance between opportunity and risk, local adaptation, and global integration. This decision will not only shape CZM's European footprint, but also influence its global business trajectory. Thank you for exploring this case with us as part of the Case Study Learning Series in International Business by SkilledMBA. We hope it provided valuable insights into cross-border expansion strategy, risk management, and decision-making in a global business context.